At first glance, Iran and Israel's war seems like a Middle Eastern tragedy. But squint, zoom out, and you'll see something bigger. The tremor from Tehran doesn't just rattle Tel Aviv. It shakes Washington. And it echoes in Beijing. Welcome to FluxFolio Finance. Because this isn't just a story of rockets and radars. It's a story about trade routes, dollar dominance, and the fragile détente holding together the world's two largest economies. Let's set the scene. It's 2025. After years of tech wars, tariffs, and Cold War rhetoric, the US and China have finally carved out a narrow ledge of economic cooperation. Call it détente. Call it pragmatism. But both sides know this. Global supply chains are too entangled, inflation too persistent, and growth too slow to afford another rupture. Washington is dealing with debt ceilings, Moody's downgrades, and an election year. Beijing is managing youth unemployment, property defaults, and deflationary tremors. Neither can stomach a full-blown decoupling. And so, handshakes happen. Rare earth agreements. Agricultural purchases. Semiconductor frameworks. A trade thaw, delicate, unfinished, but real. And then, missiles. Not just any war. A regional clash in the most strategic oil corridor in the world. The Strait of Hormuz, where 20% of global oil flows. Where the US Navy watches. And where China gets nearly half its energy imports. Suddenly, peace talks stall. Ships reroute. Insurance premiums double. Brent crude jumps to $90. And inflation? The dragon everyone thought had been slain, starts breathing again. This is where geopolitics collides with economics. Because Iran isn't just Iran. It's China's Belt and Road partner. It's Russia's wartime ally. And it's the one country willing to sell oil in yuan. Israel isn't just Israel. It's America's cornerstone ally. A regional tech superpower. And the access point for any Western influence over Gulf security. The US bombs Iranian nuclear infrastructure. Iran strikes back, threatening to close Hormuz. And in the middle of it all? China, trying to keep trade flowing while its energy lifeline wobbles like a candle in the wind. This isn't theoretical. It's practical. The moment Hormuz is threatened, China's calculus changes. Do they challenge the US Navy presence in the Gulf? Do they send peace envoys or warships? And what does the US do when China buys oil from Iran, despite sanctions? These aren't distant hypotheticals. They're questions raised inside the rooms of power in Beijing and Washington, right now. But there's more. Because oil isn't the only thing flowing through Hormuz. What's really at stake is trust. Trust in trade continuity. Trust in maritime freedom. Trust in global rules. If China sees US military actions destabilizing the region, it may question the post-World War II order. If the US sees China leveraging Iranian oil deals to skirt inflation, it may revisit tariffs or sanctions. And the trade deal? That fragile little bridge built after years of animosity? It starts to crack. Tariff pauses are re-evaluated. Tech cooperation frays. Dollar settlements are re-examined. Because trade isn't just about containers and contracts. It's about confidence. And confidence is leaking like diesel into warm Persian waters. Meanwhile, multinational corporations are watching, nervously. Apple wants Chinese factories to keep humming. GM wants EV supply chains to remain stable. Walmart needs low-cost shipping. Taiwanese chipmakers need calm seas. And everyone, from hedge funds to policymakers, is watching the oil price like it's a geopolitical thermometer. Every $10 spike in crude threatens to undo months of inflation progress. Every Iranian proxy attack on a ship raises freight costs. And every headline from Gaza or Hormuz becomes an input in the risk models of every CFO on Earth. This is the web we've built. Complex, interlocked, fragile. And the Israel-Iran conflict is the spider shaking the net. And the net includes currency. The petrodollar system, the idea that oil is settled in dollars, has already been eroding. But now, under stress, China is accelerating its alternative. Yuan-denominated contracts. Digital renminbi pilots. Bilateral pacts with Saudi Arabia and the UAE. The more the US is seen as a destabilizing actor in the region, the more China makes its pitch. Trade with us, in our terms, under our protection. It's soft power. And it's working. Gulf nations aren't ditching the dollar. But they're diversifying, hedging, and watching which superpower brings fire, and which brings funding. Let's follow the ripples. Because in the financial world, war is rarely just about bombs. It's about flows. Of goods, of capital, of data, of trust. And when those flows wobble, currencies shake. Credit tightens. Monetary policy hesitates. And markets enter a new realm. Uncertainty priced into everything. First, the Fed. The Federal Reserve has spent 2 years trying to tame inflation. Rate hikes. Forward guidance, QT. All aimed at one thing, a soft landing. But war in the Gulf changes the weather. Oil surges. Transport costs rise. And suddenly, the disinflation narrative is cracked. What does Powell do? Cut rates and risk fueling inflation? Or hold and risk breaking the economy? It's a bind. And Beijing knows it. Because in that hesitation lies opportunity. China can play monetary judo, managing its own rates, maintaining stimulus, and leveraging the inflation panic in the West to attract capital, secure trade, and consolidate commodity deals. This isn't a shooting war. It's a shaping war. Shaping who sets the rules. Shaping who bears the cost of conflict. Then there's shipping. China's Belt and Road isn't just ports and bridges, it's about sovereignty. Reducing dependency on US-controlled straits. Building pipelines through Pakistan. Establishing overland corridors via Central Asia. Why? Because Hormuz is a risk. If the strait closes, even temporarily, China loses billions per day in oil trade. That's not acceptable for a regime that prizes stability above all. So what do? They hedge. They buy oil from Russia, even at a discount. They build strategic reserves. They speed up long-term LNG deals with Qatar. And they pour money into domestic alternatives, nuclear, hydro, coal. Meanwhile, the US is stretched. Protecting shipping lanes. Backing Israel. Maintaining Indo-Pacific deterrence. All while managing internal polarization and a looming election. And what of trade? It suffers. Already, container costs have risen 30% in 2 weeks. Insurance premiums for Gulf shipping doubled. Companies are scrambling, again, to diversify. But diversification takes time. You can't move rare earth processing from China to Arizona in a year. You can't replicate Taiwan's chipmaking in Oregon overnight. And so, the fragility remains. For every supply chain that gets rerouted, 5 others stretch and bend and hope nothing snaps. This fragility leads to price spikes. And price spikes lead to policy overreaction. And overreaction leads to decoupling. Slow, reluctant, but real. Now let's talk alliances. The Israel-Iran conflict has created a diplomatic maze. The US backs Israel. China calls for restraint, but quietly signals sympathy for Iran's position on sanctions. Gulf states walk a tightrope. India buys oil from Iran and trades tech with Israel. Turkey plays mediator. Russia fans the flames. And through it all, global markets try to find signal in the noise. But here's the signal. Trade is no longer separate from geopolitics. It's married to it. The era of benign globalization is over. Welcome to strategic globalization, where who you trade with reflects who you trust. And that trust is vanishing. So what does the future look like? There are two roads. In one version, the conflict ends quickly. Diplomacy holds. The US and China resume cautious engagement. Markets recover. Hormuz stays open, and the trade deal stabilizes. But in the other, conflict simmers. Missiles return. Iran tests the strait. China is forced to choose between neutrality and quiet alignment with its energy partner. The US responds, with pressure, tariffs, sanctions, and strategic decoupling. Suddenly, we're in a cold trade war. Capital fractures. Reserves diversify. Tariffs return. Inflation becomes a structural feature, not a cyclical one. And, made in China, becomes a liability, not just a label. And then there's tech. If the Israel-Iran war bleeds into cyberspace, into hacking, satellites, infrastructure, then semiconductors, cloud systems, AI platforms become battlefields. Intel, Nvidia, TSMC, Huawei, all sit at the edge. If Hormuz is the oil choke point, semiconductors are the logic choke point. No chips, no supply chains. No data, no defense. And both the US and China know it. Which is why the war in the Gulf is more than a war. It's a signal. That globalization is splintering. That trade is political. And that peace isn't just the absence of war, it's the foundation of commerce. So, what should investors do? They must adapt to a world where war is part of the macro backdrop. Where risk isn't an exception, it's the price of entry. Where diversification isn't just across sectors, but across ideologies. This is not about fear. It's about realism. The Israel-Iran conflict is not the end of global trade. But it is the end of innocence. The end of believing that supply chains are safe just because they're efficient. Now, they must be resilient, redundant, and, at times, expensive. But survival is worth the cost. Thank you for watching FluxFolio Finance. If this opened your perspective on how regional conflict reshapes global trade, give it a like. Subscribe for more long-form economic insight rooted in truth, tension, and clarity. And leave a comment. Where do you think the next flashpoint will rewrite our economic future? Until next time, stay informed, stay strategic, and follow the flow behind the headlines.